요새 투자 어떻게 하고 계신가요? 주식을 하자니까 변동성이 너무 심하고 채권은 좀 지루하고 이럴 때 딱 중간인 게 고수익 채권 하이일드인데요. 우리나라에서는 이 마땅한 투자처가 잘 없습니다. 다만 글로벌 하이일드 시장은 굉장히 크거든요. 미국이나 유럽의 기업들에 투자할 수도 있고요. 그렇기 때문에 오늘 홍콩에서 글로벌 하이일드 전문가 한 분을 모셨습니다. 관련해서 이야기 한번 들어보도록 하겠습니다. Hello, Karen. Thank you for joining us. And you're a fixed income expert. And could you tell us about your career path as a fixed income specialist? And how did you join Bearings?
Sure, absolutely.
And what's your job and responsibilities in Bearings? Yeah.
Absolutely. Good afternoon. Thank you very much for having me. It's great to be back in Korea again. So just in terms of my background, I started off my career actually working in consulting to begin with. So I was working in economic consulting and then investment consulting. And so I'd always, through my early career, had quite close interactions, engaging with clients, informing and educating clients on their various financial needs. And I'd had, through my consulting background, quite a bit of exposure specializing in the fixed income asset class. So researching fixed income managers, and then also doing asset class research on fixed income markets. And so as sort of I progressed through my career, I wanted to move a little bit closer to financial markets. I really was quite interested in how markets worked, but also wanted to retain quite close integration with that client consulting sort of backdrop. And so this kind of a fixed income client portfolio management or product specialist role seemed to combine those two aspects quite well of being quite close to financial markets and then at the same time consulting clients. And so I moved to Bearings about 5 years ago. Today my role effectively is to represent our broad public fixed income capabilities to our various Asia Pacific clients. So just for context, Bearings has about half of its total assets under management, over 200 billion US dollars represented in public fixed income assets.
You must be a very good consultant for Korean investors here, because I heard Bearings are very good from the local LPs. Okay. So we're seeing. I want to talk about the macro first. So we're seeing a wide range of views on Fed policy right now. And what's Bearings' view on the likely path of the Fed monetary policy?
Yeah, that's a very sort of topical, I think, question at this point. First, I think it's important to just highlight that there are lots of uncertainties in the marketplace, and so, you know, when we're making macro projections, we just need to be a little mindful that as the news flow changes, those outcomes can change as well. So we need to be quite nimble in this environment. But I think just all else being equal, the way we're currently looking at the macroeconomic scenario is, if we do enter a world where we think you are going to see some baseline tariffs being introduced, maybe not the very extreme levels that we saw in early April, but still some baseline level of tariffs that the US is imposing globally on the world, that's probably going to lead to an environment in which growth slows down from where it has been. So we should probably be expecting an environment where the overall global growth prospects are likely to slow down, not go into a very severe sort of negative outcome, but still slowing. And then at the same time, at least near term, there's the likelihood for some inflationary pressures, be it through tariffs, be it through some of these fiscal spending concerns that the market currently has. And so with this, if you sort of have this backdrop in mind, we think sort of particularly in the US, the central bank is likely going to take a more wait-and-see approach before they cut interest rates meaningfully, while we still have some of these uncertainties at play.
So how many cuts there will be this year?
Yes, so again, I would caution it's hard to make sort of bold statements, but just based on our assessment on the markets right now as things stand, we're probably expecting the first rate cut, if at all, will probably be pushed further out, so maybe in that September time frame, and then potentially looking at maybe around 2 rate cuts for this year. So again, we think the Federal Reserve likely is going to wait a bit longer to start to see the data softening before they really start acting and cutting rates very aggressively.
Do you have view on the terminal rate?
Yes, so I think that the terminal rate is again going to depend on that path of what happens to growth over the next few years. And I think here there's still a lot of sort of uncertainties at play. If you're looking at, for example, the Fed's dot plots and their sort of longer term expectations, the view is that we probably end up at a terminal rate of around 3%. I think what we would sort of highlight is, while bonds have not been a very good diversifier in client portfolios for much of the last few years in this rising interest rate and volatile interest rate environment, if we do see an environment in which we do see more risks and more slowdown, we think the room for central banks to cut interest rates is meaningfully more. So if we go into this muddle through type of an environment, soft landing type of an environment, then that sort of 3% type of terminal rate looks fair. However, if we do see a more protracted slowdown, central banks should have room to cut rates, and that means that bonds on a forward-looking basis should play an important role in clients' overall diversified portfolios.
Besides that, there's a belief that Trump would push for the lower interest rate, and he really prefers lower interest rate. I don't know why. Maybe he was developer in the past time. So do you think that is this realistic scenario that Trump keep pushing Fed for the lower interest rate and Fed accepting those kind of requests?
Yes, so I think in terms of wanting lower interest rates, I think that makes, generally speaking, most people would want lower interest rates because it is more stimulation for the economy. So you can see sort of why that is the case. And furthermore, I think particularly if you look at the U.S. market as an example, a lot of the market, if you look at the housing market, for example, in the U.S. you have typically long-dated 30-year fixed-rate mortgage rates. Those are very heavily linked to where the government bond yields, particularly the long-dated government bond rates are at. And so a lower interest rate, again, can help to serve to provide more stimulus and accommodation to the economy. We still feel from all the discussions that we've been seeing from central banks, they are still quite fixated on ensuring that they don't act too soon, because if you start to cut rates very aggressively and very quickly, you have the potential for unanchoring long-term inflation expectations, because the view might be that the economy is already running at quite hot levels, inflation is still already above the central bank targets, and if they proactively cut rates too aggressively, that could lead to even more problems down the road. And so we think, at least from all the indications that we've had so far, and the Fed has been quite independent and firm on this point, that they are likely going to take a more wait-and-see approach and let the data do the talking rather than be heavily influenced by political influence.
Well, I want to talk about those volatilities we have so far this year.
Yes.
In both treasury market and credit market, there's a lot of volatilities. Yes, and how this volatility affect high-yield bonds as well, and would the impact will be limited since high-yield bonds tend to have short durations?
Yes, and the very interesting thing is that it's not just the U.S. market, even though there's a lot of focus on there. But if we look in our region in Asia, the Japanese government bonds have been, long-dated bonds have been coming under significant pressures. And so you're seeing this global phenomenon of governments that have become more indebted. Their debt to GDPs have increased over time. They've borrowed more money. And so borrowing costs have been going up quite significantly across the board. And so that has definitely made the case for a lot of interest rate volatility particularly in government bonds. If we look at the high yield market in terms of the direct impact, that is going to be limited, because again, typically when you're looking at high yield companies, they're issuing debt. These are typically 5-year maturities, 7-year maturities, sometimes 10-year maturity type of bond profile, so there's not as much exposure to the long end. However, if you do start to see meaningful increases in treasury yields, that can, from a sentiment standpoint, from a flow standpoint, have broader implications on all financial markets. So we think it is something definitely that the government, the administrations, and central banks will be watching quite closely. If we sort of take a step back and go to early April, a very sort of tumultuous time in the markets, it was actually not the equity market being down sort of 15+% that really caused that pause at that point in time. It was really when you started seeing cracks in the bond markets, treasury yields rising very quickly, which was a key catalyst for even the administration at that time to take a pause and enact that 90-day tariff reprieve, temporary tariff reprieve. So I think governments will be sort of quite cognizant to this type of dynamic, and in this type of an environment where you are expecting volatility to remain quite elevated, particularly on the interest rate side, we think that assets that can give you more income as a regular stream of returns, and that being your driver of returns, is probably a more resilient source of total return outcomes.
Would you give me more details on the global high yield market this year? What's the difference compared to the last year?
Sure. And absolutely, if I can just take maybe one quick step back, I think when you speak about global high yield bond markets as well, people oftentimes can have very different perceptions of what that means and what kind of risk you have in these types of companies. So I think just at a high level, when you're speaking about global high yield bond markets, these oftentimes will be very large, well-established industry leaders in their marketplaces. These are not small, very sort of domestically oriented maybe types of businesses. So we have big airline companies like an American Airlines, Virgin Media, Burger King, a lot of these sort of well-established brands that will form the basis for
a well-known brand for Korean investors too.
Exactly. Yes. Yeah. And oftentimes these are publicly listed companies as well. So about 2/3 of the market is publicly listed, so they have access to lots of financing as well. So it's a well-established market. If I look at sort of some of the differences this year versus last year, one of the key differences has been last year we saw quite a strong rebound in the market where there was very strong total return outcomes. We were generally seeing credit spreads tightening, and it was actually the lower quality segment of the high yield market that formed the strongest. So some of the companies that have lower ratings, even triple Cs, that did the best because again, you were starting at wider spread levels, people were more comfortable with taking risk and coming into the market, and so you saw that spread compression. What we're seeing this year, I think, is a little bit more reservation. So as an asset class, it's still done well. So on a year-to-date basis, despite all this volatility that we've had, we've still delivered sort of over 2% type of total return outcomes. So it's still sort of steady positive returns. But you are starting to see more dispersion at the underlying asset class level. And so I think as we continue to move forward in this environment of lots of uncertainty, lots of headline, macro, geopolitical sort of news flow, it's, we think, going to become more and more important to really look under the hood, do your bottom-up analysis, and be very selective in where you take risk.
How about the big trend of the market? Is there any structure change in high yield market after like 2020s? And
sure. So I would say, again, if you're looking at the main structure, so there's been quite a lot of evolution in the high yield markets over time. We've seen through the 2008 global financial crisis, there were lots of regulations that were put on banks. In the last 10-15 years, we've also seen significant growth in the private credit markets as well. So I would say the big change that we've seen in the global high yield bond market over the last sort of 15 years or so, so a broader trend, has been generally the credit quality profile of the market has improved quite meaningfully. So today, when you're looking at the global high yield bond market, over 55% of the market is the BB rated segment. So that's the highest quality of high yield. and you're really sort of the riskier segment of the market, which is triple C's and below, that's around 10%. So nearly almost half of what it was before the 2008 global financial crisis. And so from just an overall quality standpoint, the size of companies that you're lending to, that has sort of improved quite significantly. And then the other trend I would sort of say that we've noted in the last few years has been just generally the emphasis on the sort of profile of the companies that we're lending to, or the kind of debt that they're issuing, or the reason they're issuing that debt is predominantly been for refinancing purposes. So, you know, previously, and you have to kind of go back before even COVID-19, sometimes companies would issue debt for mergers and acquisitions, a leverage buyout, some dividend payouts, refinancing purposes. And what you've seen in the last few years, because there's been so much uncertainty, whether it was COVID, interest rate hikes, or now with these trade concerns, that most companies are actually just issuing debt for predominantly refinancing purposes. So just their debt is coming due, they're going to basically issue new debt to extend the maturity out, and they're not really issuing a lot of debt for more speculative mergers and acquisition kind of sort of outcomes. And so all of this has meant that company balance sheets are typically more conservative. They're not taking excessive debt. And so that to us also means that there's quite good resiliency in the underlying fundamentals of companies.
And it's a good environment to invest in the high yield markets, right?
Yes. Yes, we agree. So
And your team is known for deep analysis. And are there any particular regions or industries you find is especially compelling?
Yeah. So I think again, just if you look at the Bearings proposition, so one of the key, if you look at high yield as an asset class, the the way we believe to make consistent returns in this asset class is to do that bottom-up analysis and be very deliberate in who you're lending to, because really the outcome here is you're lending to a company, they're paying you hopefully an attractive income level, and then you want visibility on getting your money back at the end of that loan. And so that willingness and ability of the company to pay back is quite important. And so this means that you really need large teams that understand and are doing that research to make that credit determination, and you're not reliant on rating agencies or other third-party sort of databases to make that assessment. So we have very large established teams at Bearings to do this analysis. As we look at the market environment right now, and again, it remains constantly evolving, even entering, I would say, before these tariff-related issues really blew out, even entering into this year where spreads were, where the overall macroeconomic environment was, we were generally trying to avoid some of the more cyclical sectors. So, sectors like retail, automotives, even some of the real estate sectors, we were being a little bit cautious on those segments of the economy, some of the industrials, chemicals producers rather, and instead focusing a little bit more on opportunities in some of the more less cyclical segments of the economy, so like a telecommunications sector, or a healthcare sector as well. These tend to be less cyclical, sometimes more domestically oriented as well. But I think just taking one step further from here, even when you're looking at, let's say, a sector like healthcare, and there's been a lot of noise in the media around also what's going to happen with drug prices and aspects in that regard, you really need to go a step deeper than just looking at sector level exposure. So it's a very different potential outcome if you're a generic drug manufacturer where you're, let's say, producing in the US, selling into Europe. Some of those business models could be more vulnerable if there's some changes to the regulations around pricing. Whereas if you're a specialty pharmaceutical provider, you have patents that are protecting your products, your revenue prospects and profit margin prospects are very different. And so hopefully by having those large teams, we're able to dig into that level of detail and make the right determination.
Well, it's always important to know who you're lending to.
Absolutely.
And Korean investors, they're allocating their assets not just in domestic market, but also in foreign market. They're investing in U.S. equities, real estate, infrastructures, private credit sometimes.
Yes.
And why should Korean investors consider allocating to global high yield? What investment strategies do you recommend for them?
So I think the case I would make for sort of an asset class like global high yield is, again, in a client's portfolio, you should have all different sorts of investment prospects over there. One of the things that we've, I think, learned quite clearly in the last few years is trying to make bold macroeconomic projections is very hard. So even if you go back to 2022, 2023, lots of people were calling for recession, which never really took place. And then through this whole tariff volatility from April onwards, we've seen lots of banks and sell-side forecasts make bold recession predictions, then only to have to pull it back as new information has come across. And so making bold macro projections is going to continue to remain very tough in this uncertain environment. And so the reason we like high yield as an asset class is that because most of your returns here are being driven by income, you're getting a very healthy level of coupon. In some of our strategies, we're earning over 7% type of coupon levels. That is providing a lot of resilience to your total return outcomes, whether you see some interest rate volatility. Again, high yield has less interest rate volatility than some of the longer dated bonds. And so that can add a lot of resilience to your total return outcomes. Now, in terms of just the strategies, I think we still prefer having global allocations because that can give a manager, an active manager, the ability to move through sectors and regions as relative valuations change.
I think it's clear that Korean investors have to invest in high yield, and then why should they choose Bearings? What are advantages do you have compared to peers on other asset managers?
Absolutely, yeah. It's very important to pick the right manager and the strategy to invest in this asset class in particular. So first I would say I think in managing an asset class like high yield, where the rating quality profile of companies is lower than investment grade, you want to be very selective in where you allocate your money. You don't want to be allocating that passively. So one, we think doing these types of allocations in an active manner can add a lot of value. Now, specific to Bearings, just a little bit on our history. Bearings is wholly owned by MassMutual. So this is one of the very large US life insurance companies. We manage significant money on their behalf as well. And so if you look at our total assets under management for Bearings as a whole, we have roughly about 20% of our total assets under management invested within our global high yield platform. So this is an asset class that we've been involved in for a significant amount of time. We, through predecessor entities, started managing high yield assets in the 1980s. So we have a very long track record of managing assets through multiple market cycles. And then we have a very large team. So again, we don't believe there's a shortcut to doing that credit work when you're investing in high yield. So our global high yield platform, this includes having dedicated investment professionals on the ground in North America, in Europe. That team comprises of over 75 investment professionals. And so we believe that through that dedicated large-scale resourcing and having managed through multiple market cycles, we are extremely well placed to be able to give clients strong total return outcomes over time.
I found that in here, Korea, private bankers who are handling the high wealth clients, they cannot sell the global high yield directly to them, but they can get them the high yield when those clients ask them to. I think there's a regulation like that.
Okay.
So it's really hard for Korean retail investors and rich people to invest in global high yield market. And I heard that you have a good product for them. So would you explain that for us? Yeah.
Sure. Yes. So again, I think in the broader marketplace, these are very large, multi sort of $1 trillion sort of asset classes, and so there's lots of opportunities and different strategies that we can create. So one of the places where Bearings has actually been a pioneer investor has been in the global senior secured bond market. So these are effectively lending to companies. You're still lending it in a bond format, but you are sitting in the top of the capital structure of a company. And what this means is effectively that if a company gets into trouble, it may have to go through a default or some sort of credit impairment, because your capital is being lent at the top of the capital structure. You're senior and you're typically secured against the assets of the company. And so in that type of a negative type of an environment for a company, your recovery profiles and your principal preservation has historically tended to be much higher. And so this is another way in this uncertain environment where you're not sure of the macroeconomic environment, you want some additional protections to your investments, then being invested in this type of a global senior secured bond strategy can be one way to mitigate some of the uncertainties and risks that are there in the marketplace.
So it's a product with less risk and decent return.
Yes, so the returns have been actually very commensurate with the broader global high yield bond markets, but you've typically had a lower historical volatility within this sort of market segment by virtue of being senior and secured in the capital structure.
Thank you, Karen.
Thank you very much.
Thank you very much. 네, 오늘 베어링자산운용의 전문가를 모시고 글로벌 하이일드 시장에 대해서 들어봤는데요. 이게 보통 기관만 하는 게 글로벌 하이일드인 줄 알았는데 우리 개인 투자자를 위한 상품도 있다고 하니까요. 좀 참고가 되는 것 같습니다. 앞으로도 좋은 해외 인터뷰로 찾아뵙겠습니다. 연합인포맥스 서영태였습니다.